Hey everyone, this is Terry with Futures.io, and as always, I would like to thank you for joining us today. It is my pleasure to welcome back John Grady from No BS Day Trading for today's webinar on order flow, a piece of the larger puzzle. If you have questions, please feel free to type them into the questions box, and we'll do our best to answer them throughout the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. As always, like, comment, subscribe to the channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I will hand it over to John, and you should get the pop-up to share your screen.
All right, is it showing?
There we go, looking good.
Good to go. Okay. Thank you, Terry. It's good to be back. Thanks again to Mike for inviting me back. I've done a few presentations for Futures.io, and they keep inviting me back, so I'm hoping that means they're getting positive feedback. So thanks again. Today, I'm going to do something a little bit different. So people who may have seen some of my YouTube videos or looked at my material prior might be a little surprised about what I talk about today, but in previous presentations, I've showed the ladders, I've showed the depth of market, I've showed some sample trades, and I've covered a lot of material with regards to bids and asks and time and sales, and sort of being right in the thick of it when it's busy. So I was trying to come up with something different to present and not just rehash the same material. And two things occurred that gave me this idea for today's topics. So what I'm going to discuss with you today is the idea of context, which means looking at the bigger picture of the day, and not just the day, but conditions in general. So for example, obviously trading the ES these days is a bit different than trading it last November, December, October, right? Because of the volatility, it's so much different. So we're going to talk about context. And I had received an email recently, and I receive them fairly frequently, where people ask me about how do I assess my trades. So in other words, let's say I'm taking a trade with the trend, and I'm trying to figure out whether or not it has a positive expectancy. So obviously, if you take a trade setup and it works 9 out of 10 times, it's clearly, a good setup. If you take it, it doesn't work 9 out of 10 times, it's clearly a bad setup. But that's usually not what happens. What usually happens is you take something like that, like for example, I want to discuss breakout trades. So you take a breakout trade, whether it be through a high or a low of the day, or let's say a technical level on a chart, and it works 6 times and doesn't work 4 times, and you're either up a little or down a little, and you can't figure out whether or not breakout trades are something which you want in your toolbox, right? Your repertoire when it comes to playing certain setups. So if that's the case, how do I break it down and diagnose these trades in such a way that I can figure out which breakouts have a better chance of succeeding than others? Or if I should just drop the idea of breakouts altogether, let's say, if you're losing money on them, okay? So that was something, it's something that I'm asked frequently. And the week before Easter, I had lunch with some friends of mine, 2 friends of mine who they're not traders, but they have recently begun trading options because they're bored and they want to take advantage of all this movement. They don't want to take advantage of it, they want to gamble in it, basically. And they had made some plays and made a lot of money, and then naturally lost all of it that they made. So they called me up one day and they're like, well, you need to come out and explain what options are to us, because we really don't even know what we're doing. We're just buying puts and calls and taking shots. So during the course of that conversation, something happened, and I thought, man, this will make for an excellent story where a person can learn a lesson, because it's one thing to talk about concepts, but if you tell a story, the lesson tends to stick better in the brain, right? So I'm having lunch, and what's going to happen is I'm going to show you some charts, and people that know me are probably going to laugh at that, because I'm always telling people, don't look at the charts. You want to look at the order flow and the ladders, and I still adhere to that. I'm showing these charts to help convey the concept of context and some of these ideas, and to make them more clear and to make them understandable to, you know, inexperienced traders or novice traders. This is the day that we had lunch. This is a chart of Tesla. This was March 28th, okay? And this was a Wednesday. It was a Tuesday, that was a Wednesday, and this is when Tesla fell off a cliff and dropped $50 in 2 days. So we're sitting there, it's the afternoon, it's like 3 p.m., and one friend goes walking away and he comes back and he goes, all right, I just bought some puts on Tesla. And I'm like, what are you talking about? And he goes, well, you know, I think if it breaks this level, and the bottom of the day was 252.10. And I realize I'm showing you a stock, but concepts are, you know, cross the spectrum. Trading is trading, whether it's stocks or futures. So he goes, the bottom of this day was 252.10. So if tomorrow, if it gets through 252.10, don't you think it'll probably drop down to like 245 or 242 or maybe even 240? I mean, this thing is crumbling, okay? Now this is the Wednesday before Easter weekend. So the markets are closed on Friday, right? So Friday, Saturday, and Sunday they're closed. So he has 1 day, and he bought options that expired the very next day, okay? So that in itself is obviously a problem. It shows lack of experience. But nevertheless, he did. And where I'm going with this is he was asking me questions about it, and I tried to give him the most logical response that I could give. And I tried to explain that if you are a day trader, or if you are a swing trader, or even if you are a fund manager, and you have been short Tesla for a day, 2 days, a week, or 2 months, and Tesla breaks down like this, and you're going into a 3-day weekend, chances are they are going to buy to cover those short trades. The only reason someone's going to hold on to that is because they really believe a company is in financial distress and, you know, maybe crumbling, collapsing, going into bankruptcy, and that's not happening to Tesla anytime soon. So, or I doubt it is. So if you look at it from that perspective, this is Wednesday, you have 1 more day before the 3-day weekend. Most likely, even if the market breaks a bit lower tomorrow, buyers are going to come in and they're mostly going to be covering short trades, and that's going to prevent the market, the stock, from probably declining heavily. And most likely the stock will finish about where it is today, or maybe even up a little bit. And so I actually told the guy, I said, you know, if it breaks below 252.10 tomorrow, you know, all I'm saying is be careful, because it could easily turn around and go back above 252.10. Now, that's not rocket science, right? Trading isn't rocket science. But it's a very logical process of thinking if you know something about trading, and if you know something about how professionals tend to maneuver, particularly professionals who trade a lot of size, right? So if you're short a couple hundred shares, a couple thousand shares of Tesla, and it drops like that in 2 days, there's just no reason to hold on to that going into a 3-day weekend and gamble on an opening $10 or $12 higher come Monday, unless you really want to gamble, right? The reason I'm going through all of this with you today as sort of the opening act is because that's context. That's trying to anticipate what's going to happen the next day, you know, based on having a grander understanding of the bigger picture. And that's what the title of the presentation was today. And that's what I mean by order flow is important, and you want to watch it, and you want to watch level 2 if you're trading stocks, or you want to watch the ladders, the depth of market if you're trading futures. But you also have to look at that within the bigger picture. And so sometimes people will contact me, and I can see very clearly that all they're doing is they're sort of micromanaging, looking at bids and asks and time and sales, and because they think that's what order flow means, and they're discounting the process of looking at the grand scheme of things, right? And so that's what I try to tell people. So to sum that up, basically it did exactly what I thought it would do. This was the very next day. It broke below 250-210. It snapped down below 250 for a little bit, and then rallied back and closed up $6 on that Thursday, and then they went into the weekend. So, and then once that happened, of course, like it pretty much verified what I was telling the guy, and I think he has a better understanding now of how to anticipate sort of, a little bit farther out as to what's happening, okay? So to carry that a little bit farther, I have some notes here. These just keep me on point, basically, and trying to not digress or go off on a tangent, all right? Here's a comment that he said, and I wanted to comment on his comment, which was Wednesday, he was saying, well, I think if it goes below 252, it'll go to 242. Well, he doesn't have any information or experience which backs up that opinion, right? And he's not making an educated guess. He's not thinking like professional traders. He wants that to be the outcome because that he's already bought the options, and that's the only outcome which will make him money at that point. So frequently where people get into problems with their trading is people get into a trade on a whim, for example, because Tesla's down 50 bucks in 2 days. So I guess it's going down even farther, so I'm going to go short or buy some put options, right? And then try to find a reason to hold it rather than having a really good reason before entering the trade and then knowing where they need to exit if it doesn't move in their favor. All right, so pay close attention to that statement because that's really true, and you'll find that you do that frequently when you're a newer trader, and sometimes even when you're an experienced trader. You just see the market move and you suddenly react because it's like a video game, and you click your finger and you click the mouse, and it, you take a trade, and then the trade moves against you. And rather than looking at it and saying, I shouldn't have been in the trade in the first place, let me just bang out for a loss, you now begin trying to talk yourself into believing you're right. And you're only doing that because you're already in the trade. If you weren't in the trade, you wouldn't even be thinking about that trade anymore. You get in a long trade, it moves 3 ticks against you, and now you're like, well, it should come back. I think it'll come back. It'll probably come back. And if you weren't in the trade at all, you'd probably be looking at going short at that point in time, right? So you have to be very cautious about that. Let's talk about some basic trade types. You have the fast scalp, all right, which would be market's collapsing and you take a short trade and it instantly snaps in your favor, 6, 7 ticks, and you take the trade, right? That's fast scalp. You have a range play and breakout plays. So a range play would obviously be if you have the market sort of maybe like this over here, it seems to be holding in between some prices, and maybe you try a buy side or a sell side trade, expecting it to stay within the range. You have breakout trades, which obviously would be something like this, where the market's collapsing or it's going through new highs. You have with the trend and against the trend trades. Those are pretty much self-explanatory, but I mean, on this day, for example, you have a trending up, it pulls back, trending up. So buy side trades would be with the trend, or you're trying to fade it at some point and getting run over here, let's say, going against the trend. And then you have spreading and hedging. There's a little bit different, obviously, but the concept is still the same, wherein you are looking to either scalp very quickly a spread that widens and you expect it to tighten, or the spread staying within a range, etc. Hedging is a bit different, but it's all variations on the same theme. Okay, so let's take this concept of a breakout trade, which is what my friend was thinking on that Wednesday, and let's talk about how you would assess that realistically when you're going back through your trade journal, maybe going through your recordings. I highly recommend recording your trading, by the way. It's the best way to learn. And you want to know, okay, I've taken 10 breakout trades. How do I dissect these and figure out whether they were good trades or bad trades? So if you're my buddy and you have some knowledge, or you don't have any knowledge, you don't realize this 252.10, once it snaps through there, given the context, that trade really isn't very likely to work anyway, or not likely to hold. So if it does happen to snap 252.10, and he takes a short trade, let's say there, rather than the put options, and now it falls to 251 or 250, he should instantly bring a stop loss to break even, because the context is such that that market can turn around and jump right back up. So worst case in that scenario, if he takes a trade and it does move in his favor, he at least stops himself out if it comes back and he doesn't sit through a market rallying $3, $4, $5 in his favor. But you can't just say, I've taken 5 breakout trades and 4 of them didn't work. You have to look at the situation surrounding it. So again, if you're taking a breakout trade here and the market snaps, and clearly, and this might seem obvious, but a lot of people overlook this, clearly the market is crumbling, and then it pauses and you hit a breakout trade again, and then it pauses here and it bounces and it comes down and you take a breakout trade again and it snaps in your favor, right? So let's say you take 2 or 3 trades in that action as it's breaking down. When you're going back and you're looking at those trades, you have to acknowledge the environment, that was taking place at that point in time and what was happening in the sweeps that were occurring. Now, if you jump ahead to the next day, this is when the market is, getting busy in the morning. What you see right off the bat is it rallies up, it pauses, it shoots down to this area, pauses, shoots back up, pauses, shoots back down. Within that first hour and a half, you are already seeing a market that clearly is not finding direction. And it's not trending, they're not small pullbacks, it's just whipsawing, as that's the term that's used, or it's what I call a choppy mess, basically. And so when it gets down here, let's say, and you're looking at this level or you're looking at this level for a breakout trade, this is a perfect example. The market snaps through the previous day's low, and what does it do? It immediately snaps right back in to the morning range. Bounces around, goes up. Now at this point, if you've taken a short trade down here and it snapped right back in your face and obviously didn't work, you have to acknowledge that when now it's up here and they look like they're going for highs, right? Because you've already seen it snap around and the breakout fell here. Why is the breakout going to work here? And as you see, it didn't. And I realize hindsight is 20/20, but in the moment, you can see how bad the action is. And again, that's a good example is if you did take a long trade for a breakout, your stop should be put at break even, because if it snaps back to you, it's probably snapping back into the range again. That could be determined by watching the opening action in the beginning of the day. And then as you see, the market is just a big choppy mess the rest of the day for the most part, snaps off here and then snaps right back in. And if you were to look at like market replay activity of this activity right here and put it up against the activity from here to here, the difference is very apparent. I mean, it's obvious to anybody, even the most novice of individuals. So when you're looking at your trades, that's how you have to assess them. And another example of that would have been yesterday. I was noticing this yesterday with the ES. It started off with a bang up and dropped and then came up again and then began pulling in here. And once it got into this area right here in the afternoon, what I was noticing is that the advance versus decline for the day of your exchanges pretty much look like this all day from that standpoint, from that point forward. So you essentially have an equal amount of advancing stocks versus declining stocks in every exchange, a little bit more over here in the Amex, and they went back and forth throughout the day a little bit, but that's what they look like for the rest of the day from noon on. And so if you're noticing, and this is obviously if you're an ES trader, but it doesn't matter if you're trading gold or oil or treasuries, which is one of my main products, would be the treasury markets. If you're trading stocks or you're trading the ES futures or the NASDAQ futures, the Dow futures, you have to look at that, because at one point during the day, the Dow was down, the S&P was down a little bit, but the NASDAQ was up, right? So if you step back from the ladders and you look at that scenario and you're trying to assess the context, it makes sense that what you are probably going to see in the futures is just a lot of back and forth. And that is what happened yesterday. I mean, he goes up, goes down, goes up, goes down, goes up, down. He breaks a little bit here, but then immediately rallies back up. Why is that? It's because there's not a clear trend. You don't have a situation where you're seeing 75, 80%, advance versus decline or decline versus advance across every market, which is what you would have been seeing over here, when this was happening. You would have been seeing the declines, overtaking the advancing issues, and therefore you have a market responding to that, and you have the major stocks leading the way, and the ES futures are crumbling, as sell orders are hammering bids. So, get to my notes. When you're looking at whatever the kind of trade it is, that's what you should do. You should classify it: fast scout, range play, breakout play, trend trade, and then you should look at the context of the situation and the day. Today, for example, in treasuries, right off the get-go in the morning, not the very beginning of the morning, but pretty early, treasuries started selling off, and the bids just were getting crushed. And so if a person was to take a short trade with the trend in that scenario, you can't just say I took a short trade and it worked. You look at it and you say I took a short trade, and then what happened? Well, then the bids got crushed and they kept offering lower, offering lower, offering lower. And people were just getting run over. So a short trade in that condition makes much more sense than if the treasuries move down 3 ticks, go back up 3 ticks, move down 5 ticks, go back up 3 ticks, move down 6 ticks, go back up 5 ticks, right? It's a very different situation. And so break your trades down in a way where it makes sense. So something else I wanted to discuss, and I'll keep this presentation short. We'll wrap it up after this and do questions. This is something new traders, they don't really acknowledge in the beginning, or they don't understand in the beginning. New traders often think of trading the way they think about normal jobs. So they think they should be able to make money every day if they can just find the right strategy, right? And what happens is you'll often find you're not taking full advantage of the very good conditions, and you're forcing trades in poor conditions because you're looking at it in terms of making money every day the same way you would at a normal job. Whereas professionals, when they're in a good situation, they trade size, and they increase their size. And when it's a bad situation, they do nothing, or they substantially decrease their size. So if their normal size maybe is a 20 lot, they cut back to a 5 lot, and if they lose a couple times in the 5 lot, they just quit so that the trade is good again. So I often, again, these are questions that I get, and that's why I'm sharing them in this presentation. Someone will ask, well, can't you do something, you find some way to make X dollars per day? And I'm trying to explain that's not the way that it works. What typically happens, and the way that professionals view it, is that when the market is crumbling like this, a professional will swing a 20 lot on the way down and try to hammer out as much money as he can, as fast as he can, in conditions that are really, really good to day trading, or his style of trading, let's say. It may not be breakout trading. You might find you're better at range trades or something like that, but you swing size on those trades. So a professional tries to make as much money as possible during a collapse like this, and the next day, when he can see that the market is extremely choppy and breakouts are not working, and it's unlikely that he's really going to be able to make a good call, he just doesn't trade, and he turns the screen off, and then he comes back the next day. So something that you have to try to get past in the initial phases is you have to get past the idea of, I want to log on every day and make money. That's what you strive to do, obviously, but a big part of it is you have to just wait for the good conditions, and realistically, pros, you end up trading enough size that when you do make money, you make a decent amount, and then you try to keep from hemorrhaging when conditions are bad and it's very choppy like this. So I guess that's about as many ways as I can say that. So those are some thoughts for the day. It was shorter than normal, but I think I covered what I wanted to cover. So I'm happy to open it up to questions. You feel free to take over, Terry.
Okay, guys, feel free to start typing your questions in, and I will ask them to John. Okay, let's see. Do you just use the price ladder, or do you also use Auction Vista to see the market?
I just use the price ladder. I know what they're talking about. It's Vista is a part of Jigsaw. It's kind of like heat map, book map type thing. Um, for me, I just look at the ladders. I always tell people that anything you can see, on Vista or see in a chart, you can see in the depth of market ladder, but you can see things on the depth of market ladder that you cannot see in indicators and charts. And you don't want to super micromanage all the time, which some people end up doing if they're just watching the ladders. You still have to have a little bit bigger perspective, but there are moments when you're trading that you can see on the ladder that the bids are just weak or the offers are weak, and you wouldn't be able to see that information or the time in sales, how much volume is trading, if you were looking at other indicators.
What is a good time for fast scalping?
Something like that, what I was showing. I mean, when it's just breaking down like that, it's a scenario where you basically want to stick with the breakdown or the break up, as the case may be. It is of course possible that you will hit the exact wrong price and it'll snap back in your face, but that's the idea behind fast scalps and the ES futures and the stock index futures. I mean, they've been pristine for the last month plus. Um, there's these moments when they're just rapidly moving, and for the fast scalp idea, it's just going with that pressure and watching it snap in your favor and then covering, within a few seconds, and just trying to take little chunks of money out. I mean, it's always nice if you can. Sure, I mean, if you can catch the whole ride from there to the bottom, but that's not usually how it goes. With that type of trading, it's usually you catch a chunk and then you short again, then you short again, then you short again, then you short again on the way down until you finally hit a price and it snaps in your face and you lose some, and then maybe you bow out.
Okay. What would be a good time frame, do you think, for trading? What kind of charts as well do you think would be good for that fast scalping?
So I mean, if you're talking about fast scalping, it's you don't want to look at a chart at all. Um, you would want to maybe have a note of some really critical key level, like a moving average or a previous days, kind of like that. You would, if you were trading on this day, you would want to know the low of the previous day. But when the market's moving, you don't want to look at charts or anything else. What you're just doing is you're just playing pure momentum, um, and looking for fast breaks in your favor, and that's it. So you want to have your entire focus on the ladder when the action is really fast and furious. And by the way, that actually helps me, or there's something I can add to that, which is when you're again viewing context and you're assessing trades. Let's say it's jobs report Friday and it's 8:30 a.m. and the number's just been released. The markets are obviously going to be fast and furious when that happens. Well, treasuries are anyway, because they're already in full swing. So making trades, between 8:30 a.m. and 8:50 a.m. on jobs report Friday is far different than making trades at 1 p.m. when there's no news and nothing's happening. I mean, something might be happening, but the markets may be ebbing and flowing in a much more smooth fashion. So when you're breaking down your trades, you got to look at them that way as well. Break it down so that these were trades taken directly after a news report was released, and these are trades that I took, at 11 a.m. and these are trades that I took at 2 p.m. and these were the conditions surrounding them. And you'll find where your strengths and weaknesses tend to be if you'll be very rigid with regards to how you classify your trades.
Okay. Do you follow the news when you're trading throughout the day?
I do not. I mean, here's why. If you're watching the ladders, you can see it on the ladder immediately. So if something happens, they just go haywire, and it doesn't really matter why they're going haywire. I mean, it does. Let me rephrase that. It matters. The news does matter, but from a trading perspective, you're trying to play that momentum when the news breaks, and you can see it instantly in the order flow. So I'll have something up that I can then click on quickly to see if there's some breaking news that's really critical, like a war started or something like that. But in general, I don't have the TV in the background or a squawk box or anything else like that.
All right. What do you look for when you're exiting a trade?
That's a bit complicated for this presentation, to be honest, and it really just depends on the scenario. I mean, if you were making what you would consider to be a range trade, obviously your target would be the range, right? So if the range was 10 to 15, you buy 10, sell 15. If you're doing fast scalps like that where the market's crumbling, it's just kind of on by the seat of your pants. It's like it's collapsing. You let it run as far as you can see it running, and if it stops, you just bail. So yeah, it depends. Occasionally, there are technical levels that might come into play, and those might be targets. But it's very dependent upon the context and the scenario.
Okay. What all do you consider for context when trading?
You want to consider whether or not there's news. That would be number one. News releases scheduled. So jobs reports, consumer price index, consumer confidence, GDP, durable goods, these types of things. You want to be aware of FOMC meetings, FOMC announcements, if you're coming into a holiday weekend, like I discussed earlier. So those would be the first situations, and then you want to be aware of time of day, because that usually has a role. You'll notice that often markets do die off a bit around lunchtime and then pick back up. And then just kind of how it's ebbing and flowing. Is it currently moving quickly? Is it moving really slow? In the last 10 minutes, have 20,000 contracts traded or have 2,000 contracts traded, right? 2,000 contracts have traded, pretty unlikely you're going to see anything of interest in the near future. If 20,000 contracts have traded, then it might be ebbing and flowing, and there may be some opportunities in there. Stuff of that nature.
Okay. Let's see. Do you look at volume profiles at all?
I do. I look at the cumulative volume profile, so that would be the amount, the aggregate amount that has traded at each price, and you can see that in a column. Every depth market has it usually. I don't use like traditional market profile where you have the A's and the B's and the C's. I find that to be a little too, not just subjective, but lagging, I guess, in terms of people are looking back, and sometimes it doesn't matter what happened yesterday. But yeah, I definitely watch the amount that trades at every price throughout the course of the day, and the overnight session as well.
Okay. Do you okay, let's see. Do you have any books you would recommend for the emotional aspect of trading, or any books you like in general?
That's a good question. In general, some of the classics are still good. The books like Reminiscences of a Stock Operator and the Market Wizards books, even though they're dated, they still have good information. If you can understand what those people were describing, then you can get a feel for what you're actually seeing. So for example, I always make the comment about trading size, and the new trader asks, what do you mean trade size? And what I mean is, are you trading 5,000 contracts, or are you trading a 5 lot? Because if you're trading 5,000, you're a major player, and you can have an influence on movement. So if you think about that as you read through some of those interviews, and you can find other interviews online, that's pretty good. In terms of psychology, it's stuff that's not really even trading related would probably be the best. I mean, I don't want to get into that too much, but books that kind of help you understand how your own mind works and how reactionary you are. Most people think that they're always using their free will to make conscious decisions, but in reality, they're often reacting to external stimuli without even realizing they've been programmed to do that. And with trading, I guess here's where I would say with that, most people initially view it as a business. They get into it and they think, okay, if I can just design this system and it can make me X number of dollars, this will be my business. But the instant they turn on those screens, it becomes a video game. And now it has that effect on the brain where, you have the joystick or whatever, the game controller in your hands. And if you're playing a video game, it'd be nonstop activity. And you're not playing a video game when you're trading. You're trying to buy low, sell high, and just make money, but you fall into that pattern of always wanting to be involved in the market because of the way you're affected by the stimuli. So I would say try to keep that in mind at all times, and remember that this is a business, supposed to be a business, and the goal is to make money, and you don't make money by constantly being involved or by making very, very poor decisions. When the context and conditions are wrong for good trading.
Okay. How would you consider an offer to be weak, for example?
Yeah, I'm sorry I don't have any images for that. But basically, just less, and that can change clearly, But if you're looking at a bid of 1,500 versus an offer of 100, I mean, they're going to print the offer. I mean, it's almost a guarantee, right? And it's not always, but most of the time. So when you're looking to get in and out of trades and maybe save some ticks on your entries and not pay the bid ask every time, that's the kind of stuff you want to watch for. I mean, is the bid pumping up to 500 and the offer dropping down to 50? If it is, and you want to be short, you can probably offer with the 50 you get the fill. That can change rapidly, obviously, but that's what you want to keep an eye on as the day progresses. And you'll notice, particularly if you trade slower markets, that that's a frequent thing. You'll have situations where you can very clearly see that the one side is much bigger than the other, and it doesn't mean, it's not a guarantee it's going to go up or down, but it's usually a sign that right in that area you have a little bit more power on one side than the other, and that may hold temporarily.
Okay. When scalping, am I looking to spot flow with a likely low puke point and try to ride the liquidation pressure?
Pretty much. About what he means by puke point is, for people that don't know that terminology, if a guy is in a long trade at, say, 15, and not one guy, let's say the market's been going back and forth all day, and 15 is considered to be support, and you figure that there are a lot of long trades basically hoping 15s hold, and if they don't hold and the market goes 14, 13, then the long trades are going to hit 12, 11, 10 to exit for a loss. That's long trades puking for a loss. That's trading terminology from like trading offices and prop firms. So yeah, that's kind of what you want to see. If you're in a trade and you think it's a spot where guys are liable to puke, that often is what helps create stuff like this. Because you get some guys that are long and they start puking, and then maybe some other guys buy down here thinking they're just going to bounce, and it does it, and then they have to puke, and so on and so forth. And you get a trend or a domino effect.
Okay. Have you ever used an order flow footprint type of software? If yes, which ones have merit? If not, why not?
I do not use footprints because, well, for a couple of reasons. The main reason would be that when I learned how to trade, all I had access to was depth of market ladders. So I basically had a few ladders side by side, and that was it. All this other stuff that exists today didn't exist when I was learning. So therefore, I had to learn that way, and that's what I know. So that's something of a personal preference. The footprints also take up a lot of screen space for me. So I would rather have, I'd rather have 5, 6 ladders side by side than to try to figure out how to put more footprints on there or put them on a separate screen. And I think what you'll notice, and I'm not knocking it, I mean, I know some people like footprints, and if you do, that's fine. But you may notice if you just watch the ladders, you can see what you see in the footprints as well. If you do have a hard time remembering, then maybe footprints will benefit you. But in the beginning, I would recommend just sticking with a bunch of ladders side by side. And, like if you trade treasuries, keep 4 or 5 treasuries side by side. If you trade stock indexes, watch the ES and NASDAQ, the Dow side by side. And I think you'll learn more from that than you will if you had footprints of each one. But that's just me.
Okay. How do you determine when the market is trending versus ranging?
I can't really answer that. I mean, not today. It depends on context. So what you're basically watching for is just again, today a good example would be the U.S. Treasury notes and bonds. I mean, they just started going down, and it was nonstop, and they just were not backing up the entire way down. Bids were getting obliterated. So that's kind of a good example of what you want to see if you're looking to capitalize on a trend. Versus, like I said earlier, if they go down 3, up 4, down 2, up 4, down 6, that's obviously not a trend. And sometimes you can spot that, again, like this, as the day begins, spot it early and just get a feel that there's no trend developing. So could be a tough day.
Okay. As a 10-year veteran of failed trading, of price action trading, I'm still afraid to get into a trade even when it's obvious. What advice do you have for me? I feel I still need confirmation of some sort.
So don't take this like I'm not being flippant in the least. You just have to do it. I mean, and that's kind of part of some people are, I think, hardwired, and I'm not saying this person is not or can't learn it, but some people are hardwired in such a way that risking money doesn't bother them. No one likes to lose, but it's sort of in the personality, depends on your background and how you grew up. And most of the guys I've met who are good traders were gamers when they were younger. I learned to play how to play poker when I was 5 years old, and I'm not saying that has to be the way, but if you're going to trade, you have got to simply acknowledge the fact that whatever money is in that account is at risk. It doesn't mean you want to blow it or be stupid about it, but it is what it is, and to play the game right, you can't think about it. So if you've been doing it for 10 years and you're still having a hard time pulling the trigger, honestly, it may not be for you. If you want to try and get past that, my best recommendation for you would be to set up a parameter in which you take every single trade you think you should take until you hit a certain drawdown limit. So let's say, and this would depend on the product, okay? But let's say if you lose 20 ticks, you're probably doing something wrong. Let's just say that, okay? But until you lose 20 ticks, you got to take every trade you see. And that's all there is to it. If you want the confirmation every single time, you're going to miss, half or more of the great setups that occur. It can't be that way, because by the time you get the confirmation, the market's already moved away from your ideal entry price. So that would be my recommendation. It would be like, identify where you really know something's off and the strategy isn't working, and then set in stone that amount, and then take every single trade you see until you either hit that amount or until you make money. That's the only way past it. And I wish I could offer like psychological advice on that, but I can't. It's just, you just got to click the mouse and make it happen.
Okay. Uh, oh, where did it go? Is there spoofing in the order book?
There is spoofing in the order book frequently, but honestly, people attribute a lot more importance to spoofing than they should. It's so common that once you've watched for, even if you just stare at the ladders for a month, you'll really become adept at knowing which orders are spoofs and which ones aren't. Sometimes it's just really obvious that bids and offers are pumping up and they're pulling away, and it's just, and it doesn't have as much of an effect as people think it does. There have been situations where very thin markets were spoofed by guys. That's where some of these lawsuits are coming from. But most of your heavily traded markets like this, the stock indexes and treasuries and oil and everything else, spoofing is really fast and doesn't typically work for more than one tick. So it's not something with which people should be as concerned as they think they should be.
Okay. Uh, do you ever average into a trade?
Only winners. I never average. Well, 99.8% of the time, I don't average in a losing trade. If I think I'm just slightly early on like a turnaround trade and it moves against me, 2 ticks or something, and I'm pretty sure I have it, I might, but hardly ever. And I do not recommend it, especially to newer traders. You should never average into a losing trade. It's the easiest way to lose your entire bankroll.
Okay. When news events happen, like today, do you step aside, or are you still able to see things well enough and trade it?
It depends on the situation. I traded all day today. So, but there are slow periods and faster periods, right? So, if it's moving well, and I think the opportunity is there again, I will trade it regardless of news or no news. If it's really snapping back and forth and there aren't any obvious levels and we're nowhere near the higher low of the day, and it just doesn't seem to be making any sense whatsoever, then I sit out. But it's not really news based, it's just price action based.
Okay. So in the DOM, a breakdown is identified by most of the transactions either hitting the bid if a breakdown or lifting the offer if a breakout.
That's correct. So if you see the bids getting hit by market orders, that's a very fundamental concept everyone needs to understand. And like I've covered that in the first webinar I did for Futures IO. So that's a good video for people to watch if they want to watch it. It's the order flow trading from a couple years ago. But yeah, you have to understand that in order for this to happen, market orders have to hit bids. Some people don't comprehend that in the beginning, but that's the only way it happens. You'll hear people say, well, eventually it may balance out and price has moved and the delta is the same. Eventually, yes, but in the moment when this thing is snapping from 50 to 40, it's only doing that because market orders are hitting the bids, and vice versa over here. It's only going from 20 to 35 because buy market orders are hitting offers and bidding through them and bidding higher. So yeah, that's precisely obviously what you want to see when you're playing trends and breakouts.
Okay. How do you utilize market correlations? Do you What markets, indices, indicators do you watch when you're trading the bonds?
With the treasuries, I just watch the treasuries for the most part. I also watch the ES. It does play a role at times. I caution people against looking for correlations because you tend to sometimes put too much emphasis on them, and the problem with correlations is they work until they don't work. So you may see, for example, stock indexes go up, bonds go down, but you don't take the trade, and stock indexes go up and bonds go down, you don't take the trade. And the next time stock indexes go up and you sell bonds and bonds go up too. Um, so you want to be a little bit careful about particularly like different markets. Treasuries are different because people spread them, so they play together very nicely. I mean, the same as you would watch Dow, S&P, and NASDAQ for the most part, although NASDAQ can be a little different. But I would recommend or caution against getting too caught up and looking for correlations.
Do you use hard stops or mental stops when you trade?
I have a hard stop. I mean, I have always have a hard stop a few ticks away in case of an emergency. You know, if the market sweeps on news, it's a market order to bail me out. Um, so that's always there. I will maneuver a little bit discretionarily though if that emergency stop isn't hit, just based on what I'm seeing. So it's mentally I know where I do need to be out, but sometimes I may jump out prior to that. Like I might mentally know if market moves 3 ticks against me, I definitely need to be out, but it may not need to move 3 ticks against me for me to know I'm wrong. I may be able to get out with a 1 tick loss instead of a 3 tick loss and know that I'm doing the right thing there. Um, but always have as soon as you enter a trade, you should always, whatever, even if it's 5, 6, 8 ticks away, put some kind of stop in case a news event does hit that sends the market drastically in one direction, so you can make sure that you're at least out of the trade.
Okay, let's see. Where did it go? Sorry, somebody typed and it moved the questions out of my. If you're not looking at charts, how do you monitor key levels of support and resistance?
You can see it on the ladders. That's a common question asked by people, and here's what I'm going to tell you. When when something like this happens and it bounces that hard and it comes back down, you see it on the ladder. You don't need to look at a chart to know where it bounced at. You can see the prints, the time and sales. You can see the cumulative volume profile, um, and you can see where there's heavy volume versus light volume. So again, it's another. What I'm saying is I can see it on the ladder, but if you're looking at a chart, what you can't see is the amount of volume that's traded, and you can't see the bids and asks, and you can't really get a feel for the ebb and the flow and how it's taking place. And um, a lot of people don't want to do this, and that's fine. But the first thing I always tell my students is what you need to do is you need to mark any major, and I mean major levels, not some trend line level, not a pivot point, but major obvious support and resistance, which would be like something like these points, right? In the morning from a chart, and then you minimize your chart and you do not look at it for the rest of the day. Unless you briefly need to remind yourself of something, like you didn't make a note of some point, where the market stopped, like maybe you didn't make a note of this going into the day and it's coming down, and you look at your chart real quick and make a note of this, but minimize it and just watch your ladders. And if you'll do that for a month, you'll be amazed at what you learn about markets. But most people they don't want to do it because charts make them feel warm and fuzzy inside, but they're usually more of a hindrance than a help.
If you're looking at the ladder by itself, how do you get a feel for the bigger picture?
That's a bit more experience, and that's kind of what I was wanting to share with people today. And that's why I shared that very simple story. But it's a simple story, but it's it conveys the message, which is a guy who's never traded options. When when he sees this, and he's not really traded stocks much or whatever, he doesn't understand the dynamics of markets. He doesn't understand how professional day traders think, how HFT programs are programmed, how hedge fund managers move real size. He doesn't understand any of those things. And all he's doing is just taking a shot, or he thinks something's oversold or overbought or whatever, and he's taking a shot. But even the fundamentals don't matter half the time. So to gain a feel for context, you really do have to spend some time watching the ladders and watching how they move around news events and certain times of day, and do some research and some reading, on guys that have been interviewed, fund managers and big traders, and try to start putting yourself in the mindset of how would you be trading if you were moving 100 times as much size as you actually move. If you're a one lot trader, how would you actually be thinking about moving 100 lot? If you were trading stocks and you trade 400 shares, how would you be trading if you had to move 4,000 shares? Things like that. And it gives you a better idea of why the markets do what they do and some of the ebb and flow of it. So try that, practice that, and then it's screen time as well. You have to kind of sit there. What I've been telling people lately is, guys who have started trading, let's say someone who's 23 years old right now, and he's been trading since he was 20, he's never seen a market like this. And there's no way to explain it to him when he's 20 years old. If all he's seen is kind of a normal market and a bull market, and you try to tell him, look, there's going to be a time when this thing falls in drastically, it's going to be very different. He's going to look at you like you're crazy and say, oh, I just buy the dip, so you can't fully appreciate it until you've seen it with your own eyes. That's part of the learning process.
That's actually a really good comment. I'm gonna make this the last question, and it's on over the years, as you said, markets change and shift, change regimes. How has your trading style changed over the years?
For me personally, it hasn't changed much. I started in the prop firms as a scalper, and that's what I still do. I would say maybe the biggest change is that here's what people don't understand. You constantly hear comments about HFTs and algorithms, and for good reason. They obviously exist, and they're out there in the world firing off trades all day long. Okay. But I think what the average person doesn't realize is that HFT programs and algorithms are designed to mimic what we were doing and guys on the floor were doing since the inception of trading. The whole idea is that you're going to have big players and guys that manage billion-dollar hedge funds, and if they have to position themselves into a few 100,000 shares, they're going to move the stock, right, or whatever, the futures. But on a day-to-day basis, what's happening is your scalper types are looking for spots where you can kind of capture inefficiencies. And that is what HFTs are doing as well, and they're doing it on a lightning fast level now, operating on the nanosecond level or millisecond level. There's a bunch of them. So what I've done over the years is I've tried to gain a better understanding, not an understanding because I understand it, but in terms of anticipation, where are the spots where all the buy side programs are going to try to buy at once? Or where are the spots where all the sell side programs are going to try to sell at once? Because that's what creates those sharp moves. I mean, even this is a good example. I mean, Tesla doesn't drop from 305 to 280 because, I don't know, because the stock's suddenly worth that much less. There may be some initial pressure from somebody dumping, but a lot of that is program trading, and it hits a certain point where all of the algorithms and high frequency trading programs are all going short or they're dumping long trades, and then they exacerbate the move. So I would say that's probably been what I've focused on over the last many years, is just getting a better feel for situations where I think all the programs are going one way or the other, because they're thinking like a room full of traders used to think back in the day when it was all discretionary. That work?
Absolutely, that's perfect. Thank you. Thank you for the webinar today and for spending some time with us this evening.
Yeah, man. Thank you again for the invitation. I really appreciate it. I hope everybody found it valuable. I know some people were probably expecting to see trades, but I've done that, so I was trying to offer some new material, like I said, and that's it. So yeah, all feedback is welcome. And can I plug myself? Can I just say, if you got any questions, go to my website and contact me, and I'm happy to answer.
Absolutely. Can you bring up your browser and just type the address in so it's on the end of the video? If anyone has any further questions, you can go to John's website and send him an email, contact him via social media, and he will answer them, hopefully.
I'll answer them, yes.
I'm sure you'll get flooded, but
it might take me a day or two, but I will always get back to you. I never ignore emails, so feel free to write anytime.
All right, thank you very much.
All right, thanks, Terry. Have a good day.
You too. Bye.